InFi, Episode 12.
Welcome to InFi, the Future of Finance, hosted by American economist and author Dr. Robert Murphy. Each week, tune in for dynamic discussions with business pioneers about emerging trends in finance, life insurance, asset management, technology, and more. Now, let's talk the future of finance.
Hey everybody, welcome back to the InFi podcast. Today I'm speaking with JP Richardson, one of the co-founders of Exodus. Let me just read a little bit from Exodus's website. It says, Exodus was founded in 2015 by JP Richardson and Daniel Castagnoli. JP brings the technical magic behind the scenes to Exodus. JP has published over 200 open source libraries and has written code in use by most Bitcoin and cryptocurrency software on the web today. So what Exodus is, it hosts a crypto wallet for people to use. And in the episode, we get into the distinction, like, well, what does that mean? And what's the difference between a non-custodial and a custodial wallet? So we don't assume anything on the part of the listener, because part of this is just educational, make sure our listeners here learn the ropes about how are we going to move into this brave new world of more and more of financial transactions being conducted on blockchains. But beyond that, we also just talk in general about Exodus has a very interesting story and how they raised money for the company using these techniques. So I asked JP to speak a bit about that and just his views on the future evolution of finance with these new technologies. So all in all, a very insightful discussion. I know I learned a lot, and I think you will too. So stay tuned for my discussion with JP Richardson of Exodus. JP, welcome to InFi.
Thanks for having me here.
Well, there's a lot we should discuss here, and we have to tread a fine line between, and I'm sure you get this, when you talk to people about your company, of people who really are complete newbies and you have to explain basic terminology, and then other people that realize, oh, wow, you guys are really pushing the boundaries here and you're pioneers in certain respects in this space. So maybe first, can we just back up a bit and just explain a little bit about yourself and how did you get into, blockchain, digital finance and such?
Yeah, absolutely. So back in 2011, I wanted to start this website to sell these, basically these digital goods. And I went out and I looked around like, okay, how can I accept payments online? And what I found was, okay, PayPal, they have a way to accept payments, but you have to wait weeks at that moment in time to get a merchant account. And I'm like, this is so painful. There's got to be an easier way. And I started searching, and I found Bitcoin. I'm like, wait a second. So I can take this Bitcoin address and I can put it on my website, and then I can accept money from anyone, anywhere in the world? Like, that's revolutionary. So it started with kind of exploring from the payment space, but given I already had a strong interest in libertarianism, and I followed Ron Paul back in 2006, and his campaign, I kind of came for the technology, but stayed for the revolution.
That's great. Okay, and so what does Exodus do specifically, and like what's your history with them and such?
Yeah, so started Exodus in 2015, and so Exodus is a wallet or an application that 3.8 million people around the world trust to keep their crypto assets secure, and they manage a portfolio of crypto in Exodus. And so again, we started this back in 2015, and I distinctly remember I was sitting on my couch, and I don't remember why I was I was watching Schindler's List. I had these big baggy sweatpants on. I don't remember why I really remember these silly details, and I remember kind of trading some crypto assets on one of the platforms out there, and Mt. Gox, which is an exchange that used to exist. It used to be one of the most popular Bitcoin exchanges back in the day. And Mt. Gox had just been hacked and it collapsed, and it lost a lot of people's money. And I was trading on this other exchange, and I started realizing, like, wait a second. I enjoy trading these assets, and I like holding these assets. And so I'm like, what if we built software that a person could easily download to their computer and, like I said, manage a portfolio of cryptocurrency directly on their computer and that they own.
Okay, so am I right? I did a little bit of research, and the phrase I heard is that what you guys have is technically a non-custodial wallet. Is that accurate?
That is correct. Yep, non-custodial wallet, and the words it's kind of funny how these words shift, but a lot of the words are kind of shifting more towards self-custody, because when a person that is outside of this space hears the phrase non-custodial, the word doesn't mean a whole lot to them. But when you at least hear like self-custody, you're like, maybe that implies that I take on the ownership myself. So you're absolutely right that Exodus is a self-custodial wallet.
Okay, so let's, if you will, I think part of this point of this episode is to explain these terms to the public.
Yes.
So maybe let's first start with, I'll ask you just to walk through what does that mean? Like what other possibilities are there? And then maybe we can appeal to, like, I'll have you give the case to someone who's like, you know what, that's too much trouble. I don't want to learn how all that stuff works. And maybe you can talk to that person. But before we even get there, let's explain what do these terms mean? So what do you mean self-custody? What does that mean?
Yes. So what self-custody means is that you yourself control the crypto assets. So you can think of, if we use like traditional banking parlance, and you put your money in a bank, the money has custody, the bank has custody of your money. Whereas if you compare that to, let's say, at home, you might have, you're going to have your wallet where you might keep some cash. You might even have a safe. And in your safe, you might have some cash there, and you might have maybe some gold or what have you. And so you can use that same kind of analogy and you can apply it to the crypto world. And so in the crypto world, you have exchanges. And so Coinbase, very popular exchange. Everybody has most likely heard about FTX, and we can talk about that here shortly.
Mm-hmm.
And so FTX was another very popular exchange. And so what this means is that these exchanges, they have custody of your funds. Whereas, and we can talk about the importance of that in just a minute of why that's a risk, versus Exodus. If you use Exodus as a self-custodial wallet, means that you have full control of your funds. In other words, we cannot stop you in anything that you do with your money. If Exodus were to shut down, go out of business, then you can take your private keys and you can move those private keys to another self-custodial wallet to make sure that your money and your crypto is always protected and always in your control.
Okay, great. Let me make a series of statements, and hopefully they will all be true. And at worst case, you'll just have to clarify, and you won't have to say, no, that third thing you said is demonstrably false. That would be awkward. We wouldn't even just edit it out if that happens. But okay, so in terms of like how cryptocurrencies work, there's a blockchain and there's addresses, and in order for someone to, in a sense, transfer, let's say we're talking Bitcoin, transfer some units of a Bitcoin from one address to another, you need to have the private key to be able to sign that transaction and for the public to realize that you are the legitimate owner, let's use that term, of that. Okay. And so what happened like with Mt. Gox and some other places, and it is also the case with Coinbase, that they have the keys?
Yes.
Right? Okay. So what happens, like with Coin, let's pick something that didn't have a scandal, like Coinbase right now. So people who say, oh, I got 3 Bitcoins. It's at Coinbase. Strictly speaking, the Coinbase is the one that has the private keys for that. So that person who's talking like that would not be able to go directly and move the Bitcoins on the Bitcoin blockchain to somebody else because he doesn't have the private keys. He's not, he doesn't directly control them. What is the case is that Coinbase legally owes him that, just like if you put a $100 bill in Bank of America and it's in your checking account, you no longer have you can't give that $100 bill to the grocery store. You don't have control over it. Bank of America owes it to you. They can't just go spend it and say, oh, tough luck, but strictly speaking, there's a degree of, you don't have as much direct control over it. Whereas you're saying with these self-custody cases, the client at home with their laptop has the private keys. And so Exodus couldn't take them and give it to somebody else if they wanted to. Is that all true?
Yes, absolutely. So you're absolutely right that if you hold your money on Coinbase, and Coinbase has made a great product, but if you hold your money on Coinbase, there is a risk that Coinbase, for some reason, maybe you get locked out of your account, or maybe you're in a country that was once supported and is no longer supported. Then you run the risk that your money you could be blocked from accessing your money. And that's the most important part. And so when you have a self-custodial wallet like Exodus or any of the others that are out there, you can transfer your money or do anything with your money to protect your money, and it's 100% under your control. And it may be worth just talking a little bit about the FTX situation, if you think, and why this can even be a risk outside of just the aspect of potentially Coinbase or some exchange locking you out. One of the bigger risks that can happen that we saw with FTX. Do you think that would be valuable?
I do want to get there in a second, but let's first, just this term wallet, just like how mining is an interesting term that they use. I've had other guests on there who talk about that, but just the word wallet. So there, as it suggests with paper currency, what does a wallet do? It's not the money. It's the thing where you put your money in. It's a convenient way for you to hold your money for when you want to deploy it, right? Technically, you could just have a bunch of bills stuffed in your pocket or just hold them in your hand walking around, but it's a lot easier to just store them all in your wallet to when you want to buy something. And so that's what a wallet does in the context of digital assets, is it's the thing that helps you organize and keep track of it. But again, just because you buy a wallet from the store and now have it in your pocket, it's not that the store now controls your money. No, they sold you the wallet that you still on your own personally keep custody of your $10 bills. And that's what Exodus is doing?
Yes, absolutely. So in kind of that traditional finance parlance, yes, absolutely. A wallet allows you to store your paper bills. If anybody out there still uses checks, you could put your check in a physical wallet that you have in your pocket. But these days, of course, a lot of people will use credit cards, and people keep their credit cards in their wallet. But your wallet that you actually have in your pocket becomes an easy means for you to walk around and conduct and buy goods and services. Absolutely. So yes, with a software wallet like Exodus, you can do that exact same thing. You have full control, except it is on your phone.
And right. And so the inner value that you guys are providing is the interface is very convenient and secure, so that somebody isn't having to jot down their private keys for what's my Ethereum, what's my Bitcoin, have something on a Post-it note that they have in their back pocket every time they want to buy and sell using those particular cryptocurrencies.
That's absolutely right. So a lot of people may not be aware of this, but there are tens of thousands of cryptocurrencies out there. And so Bitcoin is by far the most popular one, but the second most popular one is Ethereum, and there are a lot of other cryptocurrencies as well. So what we find is a lot of consumers, what they like to do is they're going to buy some Bitcoin, and then they get into the world of digital assets and cryptocurrency, and then they hear about this. What's this crazy Ethereum thing? Oh, this is interesting. My Exodus wallet supports Ethereum as well. Well, I know what I'm going to do. I'm just going to, right here in the convenience of Exodus, I'm just going to swap a little bit of my Bitcoin for some Ethereum. And then now Exodus as a wallet has allowed me to swap from Bitcoin to Ethereum. And now I can see my remaining Bitcoin, and I can see the Ethereum that I have, and I can see it in one beautiful portfolio and one beautiful interface. So it's all managed from one interface.
Okay, great. Yeah, I think we pushed enough on that somebody who didn't know at the beginning now at least gets the metaphor and can understand. Okay, so now yes, you mentioned part of the problem with allowing some other institution to actually maintain custody, and legally speaking, they just have a liability to you of crypto assets. You said one thing is just what if you just forget your password or you lose your phone or say it's hard, you can't prove to Coinbase that you are who you say you are. There's that element. But then you said, with FTX, of course, there was something qualitatively different from that sort of risk.
Absolutely. So with what happened with FTX is so FTX, it became a very popular exchange. And if Tom Brady's promoting FTX and Kevin O'Leary's promoting FTX and it's on the Miami Heat arena, FTX must be a great platform, a great exchange. And look, the whole world really bought into this. So Sam Bankman-Fried, or SBF as he's known, created FTX, and they started, accepting customer deposits. And then what they did through one of their hedge funds, they started borrowing customer assets and then making risky bets with those customer assets. Mm-hmm. And so then when word started to get out that this was happening, you had the equivalent of a digital bank run. So people, let's say you had, 1 Bitcoin and 5 Ethereum in FTX, and you go to FTX, you're hearing the bad news, you're like, there might be something wrong with FTX. And you decide that, you want to withdraw. You have to, you would have had to log into FTX, and you would have to withdraw your Bitcoin and withdraw your Ethereum. But the withdrawals are not instant. You would have to wait, and you'd have to wait in a queue. And because they effectively were doing a fractional reserve, they couldn't fulfill all the withdrawals. And so this created a scenario where a lot of people lost billions of dollars, and the bankruptcy trust is trying to recover all that money now. But you can imagine if you're a person in, let's say Brazil, and let's say you've been saving up 5,000 or 10,000 from the hard work on your family farm, and you've been investing in cryptocurrency, and you've been hearing about FTX because it's such a trustworthy exchange, they said, and you put your money in FTX, and maybe you're earning a little bit of yield, and then all of a sudden to have your life savings wiped out because of the lack of control that you had in your assets, because of the heinous actions that FTX did, that's devastating. And that kind of scenario happened to millions of people around the world that trusted FTX. So that's a really important implication, that when you use these custodial exchanges, you are giving up full control and trust to the exchange. Like you said, they have a liability to give you those assets back when you request them, but it doesn't always happen.
Okay, great. So I'm glad you said that phrase, fractional reserve banking.
Yeah.
I think, JP, you probably, because you mentioned before we started recording that you knew my work. So yeah, that's an area as an economist in the Austrian school tradition I published on. And that's why this stuff is so fascinating. So let me just bring the audience up to speed, JP, and then I'll ask you the question I have in mind on this. So yeah, there's been this debate. One of the probably most contentious things within the Austrian school over the last 40 years, let's say, has been this issue of fractional reserve banking. People like Murray Rothbard in that tradition were very much against it, saying it causes the business cycle. And going back to Mises' work. And then there's so-called free banking camp, both camps agree, get rid of the Federal Reserve, put money in banking back in the private sector. And even a lot of people think commodity money, this is back before crypto, commodity money is way sounder and more sensible and so forth than government-issued fiat currency. But that even with that level of agreement, they still disagreed on whether commercial banks with demand deposits should have to keep 100% reserves. And when I say should have to, either legally or just in terms of like honest accounting or whatever, putting aside the issues of enforcement, but just like what's the standard of excellence or competency. And whereas the free bankers were saying, no, let the market decide what the reserve ratio is, and banks like checking accounts can offer interest if they have fractional reserve banking, right? When you put $1,000 in a checking account and they lend $900 out to somebody for a mortgage or whatever, they can afford to pay you interest. Whereas if they're just keeping it literally in a vault and building ATMs and doing check clearing, you're going to have to pay for that service. You're not earning interest, that's for sure. And so then, and that was kind of the debate and they said, how come, it's not illegal to do that? No one's doing it. And then the 100% reservists would come back and say, well, there's FDIC, the feds, there's a lot of government support for that. If it were really Wild West, no bailouts or whatever, let every bank stand or fall on its own solvency, you'd see a lot higher reserve ratios. And that was kind of the argument. And so then when crypto came out, a lot of people were saying, well, now we're getting a better sort of experiment to see what is the public like. Do they want to be offered yield but not have control? And so that's what's so interesting in this. And don't worry, now I'm finally getting to the point where I'm going to ask you the question. Now I can see you nice. You understand like it's not even an analogy. It's almost like literally just an application in a new space with new technology. Like the self-custody, I'm keeping it like that's kind of like 100% reserve. That no, this is my money. It's not going to multiply unless the currency intrinsically does that. But it's not like some institution is paying me interest on top of it if I'm just holding it. Whereas, these exchanges, there could be reasons for convenience or whatever, but then there's the danger of fractional reserves. And so then some people are, okay, now that there's a few of these big cases that everyone got spanked, and let's see how the public responds. So I said a lot there. Do you have any reactions?
Yeah, so I guess in kind of addressing, kind of thinking about like fractional reserve banking, and I come from the school of thought that it really should be market driven. But the reality is that even though I think it should be market driven forces that determine what the reserve requirements are, it's mainstream consumers don't understand what that really means. And even today, with all the regulatory requirements that banks must adhere to, most people today, when they deposit, $500 or $1,000 into their bank account in the United States, they believe that everything is going to be okay because of FDIC. And so far, that has turned out mostly true. And I say mostly to call out that Silicon Valley Bank with, and this is, so we're talking about right now, FTX, right? And the collapse of FTX and in the trial of SBF for holding a fractional reserve. Now I understand it was fraudulent. Okay. It was fraudulent. They said they had those assets and they didn't. I understand there's a distinction there. But then in the United States, we had 5 banks that have failed this year. Right. And so then when you look at like Silicon Valley Bank, this is one of the ones that's most interesting to me because the failure happened so quickly. And, by Friday, the FDIC is in there and they're doing stuff and they're trying to figure out, are they going to insure accounts over $250,000? And for a lot of Americans, $250,000 is a lot of money. It is a lot of money. It's a lot of money for an individual. But what people aren't thinking about is that of a business, right? And so Silicon Valley Bank had so many deposits from so many tech companies. And so for a business, especially a big tech company, 5, 10 million, 15 million may not be a whole lot of money for you if you have a lot of employees, and especially when you have to make payroll the following week. And so on that Friday, you had a number of entrepreneurs wondering, oh my gosh, am I going to be making payroll given that the amount of money I had was over $250,000? Now, we know how the story turned out, that the FDIC decided to backstop and make sure that everybody was going to be okay. But how many times are they going to be able to do that in upcoming banking crises? And so back to the notion of a self-custodial wallet, and to your point, is self-custodial wallet. With the self-custodial wallet, Exodus cannot take your assets and reinvest them or do anything. You have full control of those assets. And I think that's just, again, the really important, powerful distinction with what's going on.
Yeah, great points. One thing I like to stress too with Silicon Valley Bank is it's not like they were holding mortgage-backed security or something. They were holding treasuries. Yeah. And it was just the interest rate, risk hit just caught them. Like that was one of the main drivers of what got them in trouble in the first place. So again, it just was an interesting case showing just the dangers of these things and how something that they could have plausibly argued a couple of years before and like, no, we're not investing in crazy stuff. We're holding treasuries,
That's a great call out. And even not only that, but when they started buying significant amounts of treasuries as well, Jay Powell, was saying that, nope, we don't have any plans to raise the interest rate. So they were listening to what government officials were saying and following the regulations, and they still got burned.
Yeah. As Stewie would say, what did you learn? So, yeah. So, okay. So there's that. And then, yes. And then the point about the the payroll. Apparently there was some school, I forget like what, if it was a high school or a junior high or something, but they also had their, because they were coming, because a lot of people were like, oh, I'm supposed to cry because a bunch of tech bros lost their bonuses or whatever. People were having that kind of reaction. And then I saw there was at least one school like in the Midwest, or it wasn't even in California. So I don't know why they had their money parked there, but they apparently did, saying, hey, this is a bunch of teachers' payroll that, we don't know is up in the air now. So this isn't just these tech bros, that they're going to take a haircut here. And so in the wake of that, I don't know do you know Caitlin Long? Do you know who she is?
Yeah.
Okay. Yeah. So she was, she's been, and we've had her on the show, and she's been making the case, just trying to get regulatory approval for 100% reserve bank that, has access to the Fed's network and is on an even playing field in terms of being competitive, except for the fact that it's 100% reserve, and just not being able to do that. And so they were making the case and saying, look, like for institutions, they're not looking for yield at all. They just need to park, like you say, payroll or something somewhere to know it's going to be there 40 days from now when we have to start paying these people, that there's no good option right now. Like it literally doesn't exist. So when to say, oh, it failed the market test or whatever, they're pointing out that no, we've been trading, and maybe you've heard too, JP, about the narrow bank out of Connecticut, TNB was going by.
That one.
Yeah,
no.
So what they were doing is they were just going to be like an institutional, like they weren't going to be, individuals weren't going to have checking accounts with them. They were just going to have like large institutional clients, but ones who were not allowed to have an account with the Federal Reserve, like a master account. And so TNB was going to have a master account with the Fed to be able to earn the interest on reserves and then pass that through to so they were going to literally just take deposits and then keep the reserves parked at the Fed and just pass through, taking fees for paying the lights and whatever.
Yeah.
And they for a year, like it should have been open and shut application, and they were, because there's no risk. You know what I mean? Like it's a very safe, and they weren't getting approved, and they thought it's because the other banks were realizing, whoa, we don't want to set a precedent, because a lot of people just start parking their money there. And so, but anyway, the point being, it's not so much that 100% reserve bank has failed the market test. It's like literally there's a lot of regulatory impediments, plus the stuff you said, like subsidies, either literally or implicitly, to fractional reserve banking, because the public knows, oh yeah, if my bank went down, I'm going to be made whole. So I'm not going to do research on what their portfolio is. What do I care?
Well, it calls into question, like, what are they so afraid of? For a bank to have 100% reserves, that sounds amazing for, as you mentioned, the type of customer that really just needs to 100% be sure that 40 days from now I can make that payroll. So you just have to ask, well, what are they afraid of? It's wild to me.
It is. So does that, given now that, we've kind of sketched the landscape, do you think that, and presumably that's partly why you're in this business, that there's going to be, as more and more people understand how these digital assets work, and they are going to more move into this space of what Exodus is doing in similar companies?
Yes, I have a general thesis that in the United States and abroad, that distrust for, I'll just, kind of big institutions, and you can interpret that to mean both governments and big financial institutions, is going to continue. That distrust is going to continue. I think that, if you just look at the United States over the last, let's say, 8 years or so, and you see what's happening in the United States, I think people are looking around saying, something doesn't feel right. And I know that just as a normal person that's just trying to put food on the table for my family, and I'm working hard every single day and trying to give a good education for my children so that they can have a brighter future, and I'm just feeling the squeeze. I'm going to the grocery store and seeing that milk is more expensive, eggs are more expensive, and starting to wonder, why is that? Why is that happening? Why is it harder for me to raise a family today? And why do I not trust the politicians? And so people, I think, are starting to wake up and realize that there isn't something right. And once they realize, like, there is an alternative that is being built, this alternative financial system that is being built outside of the traditional financial system. And people will continue to seek out alternatives and will start to take more interest in crypto assets like Bitcoin.
I just want to point out, JP, that you were talking about people being at the grocery store and seeing higher prices and things are getting tight. Paul Krugman has been repeatedly assuring us that it's all a myth.
It's about the tweet from yesterday, aren't you?
Yes, yeah, all a myth that's been orchestrated by Fox News. That actually, no, it's anyway, it's inside joke.
I saw that tweet. He said, we beat the war against inflation, I think is what he said. And then there was a caption that I think that said, excluding what? Food, housing, and energy, like the most important things,
and used cars.
Oh,
so
yes,
transportation also. So for folks that don't know it. Krugman lately, his favorite measure of inflation, by which he means price inflation, is CPI x food, meaning excluding food, energy, housing, and used cars. And the reason for the used cars is because there was, if you remember, JB, there was like a big blip in used car prices, like I forget now the time, like a year ago. And so I think that's partly why he wanted to take that out, is to dampen it, because that's just transitory. That's not a long-term thing. So anyway, people were having a lot of fun. It just, to me, I understand, because where he's coming from is, I want to get to the underlying trends and not, these volatile things and oil prices. That Putin changes, his mind, then oil prices can swing. Okay, but just the fact that an economist with a straight face can be talking about inflation, taking out food, energy, housing, and transportation. And see, if you take those things out, why is everyone complaining? It must be because Glenn Beck's got them all riled up or something.
See, and this is what's great about, this is what can be great about social media, because, a lot of people can, look at, Krugman's tweet and be like, oh my gosh, I can't believe he's saying this. But you can also be like, oh my gosh, I'm glad he's saying this, because it's spreading around so fast. So people can look at this and be like, again, it reinforces that narrative that, wait a second, something isn't right here. And people can pay attention.
Yeah, 100% on all those points, because it was, I don't know, like if his defenders have rushed in now to rally the troops or whatever, circle the wagons. But when that thing first dropped and I looked, it was like the first 50 comments, maybe 45 of them were making fun of him. Like, are you kidding me? Or like doing parodies and like, yes, if we take out all the gunshot wounds or whatever, then that war was actually pretty uneventful, or stuff like that. So
this is great. It makes good fodder for us and for others to have a good conversation about it. So it's all good.
Okay, so can you maybe speak a little bit about, and I don't know if this is something that you guys are like, are you big on stable coins?
Yeah, I think that stable coins are going to provide a big opportunity for both, or I should say, could provide a big opportunity for the United States if the United States would embrace stablecoin. When I say United States, I should clarify and say the US government would embrace stablecoins, because today a lot of people really enjoy using stablecoins in the world of crypto. And so what a stablecoin is you can think about it as a crypto representation of a stable value. So where is it used most? It's used most with the US dollar. So you have all sorts of stable coins. So if you have, let's say one of them is called USDC. And so if you have one USDC, it is redeemable for $1. Approximately, there might be a small variation on that, but approximately $1, right? Mm-hmm. And there are other stable coins like that are worth approximately $1. So the value of this is that as a consumer, let's say that it is heavily in crypto and in cryptocurrency, instead of, say, having $500 in your bank account, you could have 500 USDC in your self-custodial wallet. And what's great about that is that in this industry, in this ecosystem, when you start paying people, like, you don't have to be like, you know what? I missed the wire cutoff today. For a lot of people that may not know, is that every single day there is a cutoff time from when you can send a wire transfer in the United States. And so if you want to send a wire transfer in the United States, you have to beat this time. And if I recall, I think it's 1 Eastern or 1 Central. And so stablecoins allows you to easily transfer as much dollars as you want at any time. I mean, it could be on Saturday or Sunday and you can transfer. I mean, like, again, when we think about the modern financial system in the United States, and you think about it being only open on Monday through Friday, 8 to 5, depending upon what the financial service is. and you were to say, like, let's apply that to the internet and say the internet's only open, Monday through Friday, 8 to 5, people would laugh and think that's such an absurd concept. And so that today, money needs to move at the speed of the internet. Money needs to be accessible like the internet. And so stable coins really provide this value for people.
Also, no, it's not the same thing you're talking about, but I had to move money from my business checking account into my personal checking account. And so I wrote myself a paper check. I actually had a paper check in my physical real world wallet. I actually own one. And I went to the ATM and I go, and I do my thing and I put it in, and I wasn't reading carefully. And because it was a larger than amount that I normally do, because I was getting ready to leave town or something. And I just wanted to get that in there and, not worry about it. And I go in and I proved it. They put a 7-day hold on the deposit.
Oh, yeah.
And so it was the worst of all worlds, where I'm getting ready to leave town now and I don't have that. And like, I should have just canceled and written a smaller check, but I wasn't reading it. And then, oops, now I don't have the physical check anymore. It's sitting in the ATM and I don't have my money. So because the bank's going to sit on it and process it for a week to say, we don't know if we trust it, so it just underscoring, this is insane that we're at this stage where we have all this technology and yet financial processing is still like 1950s technology.
And that's absolutely right. And I have done that, what you just described, as to write yourself a check from a business account so that you can go deposit into a personal checking account. I have done that a number of times, and it's just every single time that I've done it, I always laugh at the craziness in the system that exists today in the traditional financial system, especially in the United States.
Well, so just to make sure the listeners understand, the reason I brought the stablecoin thing was because I think some people hearing your vision that we presented 10 minutes ago were like, oh, right, JP, sure, if everybody switched over and the whole world started using Bitcoin, then we could have this world of 100% reserve banking and I get to control. But that's not the world we live in right now. I got to pay, my landlord's not going to take Bitcoin or Ethereum. So I was just trying to show that like the stable coins are sort of like this stepping stone where people can get used to the digital coin environment, but without having a lot of their wealth in something that is volatile at the moment.
Absolutely. And so I think we're going to see the continued progression of growth in stablecoins. So right now, in terms of the number of dollar stablecoins that exist, there's about roughly $100 billion of stablecoins, of dollar stablecoins in usage. So that is showing that there is a lot of interest here and a lot of usage. So you're absolutely right. As more financial platforms start adopting cryptocurrency, it doesn't necessarily have to mean that, like you said, that the place where you go buy your groceries or whatever, all of a sudden just has to accept Bitcoin or some other cryptocurrency. It could be, ideally, we get to a world where you as the consumer, you just go buy the things that you need and you don't really have to think about like, is this Bitcoin? Is this using cryptocurrency? What is this using? Like, you don't have to think about the technology. Like when you get on the internet, you're not thinking like, oh, what are the protocols that are being used here? It's like, oh, I'm opening up my web browser and I'm going to go to whatever website and just do whatever you need to do. And so when it comes to payment technologies with cryptocurrency, that's a future that we see and a future that we want. We want to make it so simple, so frictionless that as a consumer, you don't have to think about all the nitty-gritty details.
Yeah, I don't know if this is a good analogy, and it obviously tell me, I mean, I know this isn't literally the same thing, and you can clarify in terms of the ways it is analogous and not, but like right now, if you're traveling to Europe or something, and you're going to a few country, and if you have major credit cards and you go to a restaurant, they're gonna take it. You don't need to know like, oh, do they do euros here or do they, you know what I mean? Like if it's a major country that's you're gonna be okay, and it's not, oh wait, hang on, let me get my credit card that is denominated in, that they take care of that behind the scenes, so to speak. And so is that kind of what you're getting at? That it's at some point that on the interface behind the scenes, we'll go ahead and, given your preferences, you can say draw down on these accounts according to this waterfall approach.
Yes, that's absolutely right. And to kind of go one step further from that, a lot of people still use, physical credit cards when they're purchasing and, like, as you mentioned, going to Europe or wherever. And touchless, like, I guess if we were to say if we were to say that there was one benefit of the time during COVID, if we were to try attribute one benefit, I would say kind of the adoption of touchless payment technologies. So when you go in whatever store, and a lot of stores now accept it so that you can just take your phone, tap the terminal, and then you can be on your way. And so we see a future where that kind of tapping the terminal extends out to your crypto wallet. And then again, you don't necessarily have to think of like, oh, this is coming from Bitcoin or Ethereum or dollars or whatever. It just seamlessly works in the background, and you can buy the goods or services that you need.
Mm-hmm. Okay, well, maybe the last section of the interview here, I'd like to pivot and can you, first of all, just explain how does Exodus make money, and then talk about, your interesting tokenization example, which is very pioneering.
Yeah, absolutely. So the way that we make most of our revenue is from these swaps of crypto assets. So as I mentioned earlier, if a person they have Exodus and they have Bitcoin, and they hear all of a sudden about Ethereum, like, oh, this Ethereum thing here is really cool, and I can earn some yield on Ethereum in a self-custodial way, then I want to do that. And so what a person can do is to just swap part of their Bitcoin for some Ethereum, and then they can hold both assets simultaneously inside their Exodus wallet. And in the process of that swap, we work with as an affiliate, and behind the scenes, we get paid a percentage of that swap.
Okay, so that's the one main component of your business model. And so then now, how did you raise equity for Exodus? And you did it in a very novel way.
Yeah, so this is really cool that a lot of people just aren't familiar with. So this was the summer of 2020. We started thinking about like, what if we built a platform where we and ultimately others could raise money directly inside the platform, and do it in an SEC qualified way. In other words, have a kind of a crypto public offering. And so this is what we started with. We're like, well, okay, we should be the first to try this out and dog food this and pioneer this and kind of learn about the process, and then ultimately build the playbook on this process. So that's exactly what we did. So in September of 2020, we filed with the SEC that this is what we wanted to do. And so what this means is that we told the SEC that we want investors to come along and download Exodus on their desktop computer with Mac OS or Windows, or on their Android or iPhone, and then be able to buy Exodus equity in a public offering. And not only that, but do it with only cryptocurrency. So we were the first company in the United States to be able to offer our equity to the common stock to the retail investor for Bitcoin, Ethereum, or USDC, the stable coin. And so that went live in April of 2021. And we did this through what's called the Regulation A offering. And so now our stock is the only stock in the United States that is the only common stock in the United States that's tokenized on a blockchain. And so today that trades on T0, and we have plans to make that simultaneously be available on the public big boards like the New York Stock Exchange or NASDAQ.
Okay, so there's actually a coin that's associated with your equity?
Yes. So you can literally go to Yahoo Finance, and the ticker is EXOD. And so, like I said, today it trades on T0 and securitized markets. And so yeah, it's literally tokenized on a blockchain. So a person can then treat equity as if it were a cryptocurrency, sort of in the self-custodial model. So let's say that you're like, yeah, I want some Exodus equity or whatever. Then you can sign up to this system, and then you would have a crypto address, and then a person you can just send equity as simple as if it were cryptocurrency between crypto addresses. So it's very novel in that approach.
But correct me if I'm misstating this, but I guess a key and important difference is something like Bitcoin. I have argued technically that's fiat in the sense that it's not a commodity per se, and it's certainly not in terms of the old school framing. I said probably economists need to come up with new nomenclature just because it seems it's confusing. But when I say it's fiat, meaning like you can't eat bitcoins, you can't build something, but it just is what it is, and it's not backed up by anything. You can't turn them in to get something else, and so that's the sense. But here, that isn't a claim on the underlying equity in Exodus. So
that's exactly right. Yes, it is. It is so if you have in your Exodus, and you can hold the shares in your Exodus wallet. So if you have the shares in your Exodus wallet, the tokens, then you have for every one, you have one share of Exodus. It's one common stock, one share of common stock for every one token. So that's absolutely correct.
Yeah, I probably misspoke, or I think I called it I should have called it a token. That's probably a safer.
Oh, yeah, it is fine. Token, coin, or that's fine. But yeah, absolutely, it's tokenized equity is what it is.
Okay, great. So that trades in a secondary market now, and that's how you get a market price. And so somebody could figure out what's the capitalized value of Exodus at any moment.
That's absolutely right. So we have to, because of this, we file reports with the SEC on Edgar, just like any other public company. We file reports through the Regulation A requirements, and so any person can look and see what our stock price is, and you can look at what the market capitalization is. Now, unfortunately, because these markets are so new, what it implies right now is that our market cap right now, this is wild. Our market cap is at any given day, it's anywhere from 60 to $80 million or so in total market cap, and sometimes it goes over 100 or so. But that's total market cap value. Given the cash that we have on our balance sheet is over $100 million, that implies that we have a negative enterprise value for a company that is going to be profitable this year and drive a little under 50 million in revenue this year. So, like I said, it's a very new marketplace, but that's okay. We wanted to be pioneers in this space.
Okay, that's interesting, and I think the listeners can appreciate that you volunteered that. Because it's an interesting fact.
It's all public. Anyways, it's all like the person could go dig it up on the Edgar.
Right. So I'm just, as an economist, I'm trying to think. I guess that's because this is just so new that investors are very hesitant to get in. And you just think over time, as they understand how this works, then.
Yeah, I would actually attribute it to that there's still a lot of friction in these marketplaces. So the stock itself, we cannot legally allow for it to be traded inside of Exodus or swapped inside of Exodus. So it has to trade on these other marketplaces. Now, we can ultimately try to build interfaces to make it a little more seamless, but these marketplaces, I think, have a lot of friction in terms of making it easy for consumers and investors to go in and actually buy and sell and trade these assets. So over time, what we will do is we will make it all one seamless experience so that you can do these trades and make it easy, but it's going to take time.
Can they get dividends on that, or is it not?
Ultimately, yes, we can. We have that ability. In other words, so if you hold like the Exodus shares in your Exodus wallet, we have that ability to pay dividends with stable coins, which is really cool. So you can imagine, let's say that we did, after earnings, when we have earnings, let's say that we want to declare that we're going to pay a dividend. Most companies pay quarterly dividends. We could say, you know what, we're actually going to pay dividends daily, right? That's what this technology enables. And then you just get it. You have your Exodus wallet, you open it up, you're like, oh, cool. I got paid my dividends today. I mean, you can actually have your dividends paid every few seconds if you wanted. Like, that's what the technology ultimately enables, but we don't use that yet. But at some point in time, that's something that we will certainly experiment with.
Okay, that's interesting. Okay, last question for you, JP, and we really appreciate your time. You can frame this however you want, but I'm curious, just the form, I'd like your thoughts on, say, like 5 years from now, this is what I'm sure the financial system, like an aspect of it that I think a lot of people aren't fully taking into account yet. Like, this is what's coming. We're getting ready for it. We see it. And yet I think even a lot of smart people who have their finger on the pulse of the system, this is not going to be they're going to be caught off guard by this. Is there anything that's coming to mind if I give you that kind of prompt?
Yeah, I would say that the biggest aspect is that Bitcoin itself will take on a lot more institutional interest. And so what that ultimately implies is that institutions and more retirement funds, big funds, are going to be buying more Bitcoin to back their funds. And so like BlackRock, they filed for a Bitcoin ETF. And for a lot of people might know and understand already that BlackRock is one of the biggest asset managers in the world. So when the US government has issues or troubles with any kind of financial aspect, they go to BlackRock. And so for BlackRock to file for a Bitcoin ETF they're going to get it approved because BlackRock, when they file an ETF, of all that, I think they've filed, I don't know how many hundreds of ETFs they filed, but of the hundreds of ETFs that they filed with the SEC, only 2 have ever gotten rejected. So I see a world where a number of institutions are going to continue to come in and be buying Bitcoin, buying crypto. And so I think for mainstream consumers, it's important to take notice of this now. I think another really exciting trend that it's early on is that a lot of people may know this or may not, but El Salvador, about a year and a half, 2 years ago, they made Bitcoin legal tender. Now, personally, I went down there in May to experience it myself, and there's still a lot of work that needs to be done in terms of making it easy to use. But this is just the beginning. They just announced that they turned on Bitcoin mining on their volcanoes. So these kinds of trends, I think, are going to continue. You see what's happening with inflation in Argentina and in some of the local politics that are happening there, and some of the presidential candidates that are very pro-cryptocurrency, pro-Austrian economics. And I think that cryptocurrency and Bitcoin is going to continue to take the world by storm. And I think it's just important for people to really notice that. And I think it will become more of a means of commerce at some point in time in the future.
Okay, well, exciting trends to be sure. So JP, thanks for your time.
Absolutely. Thank you for having me here today.
So folks, my guest this week has been JP Richardson, telling us all about Exodus and trends in the financial sector more broadly. We thank you for your attention, and we'll catch you next time.
This concludes another episode of InFi, the Future of Finance, with Dr. Robert Murphy. The information provided is for educational purposes and does not constitute financial advice. Consult with qualified professionals before making any financial or investment decisions. For more information on the host and for previous episodes, visit InFi, thefutureoffinance.io. Thanks for listening.